Okay, hello everyone and welcome to today's webinar. Before we get started, I have a few housekeeping items to go over. If you mouse over the bottom of your screen, you'll see the Zoom navigation buttons, chat, Q&A, and raise hand. You can use the chat feature to communicate with us if needed, and the Q&A feature to submit your questions. We'll be taking your questions throughout the presentation. Next, we'll be sending a copy of the presentation slides to your email after the webinar is complete. There will also be a pop-up survey once the webinar ends. It takes less than a minute to fill out and gives us feedback on how we can continue to make our virtual events better for you. I'll now pass things over to Anne and Michael to begin their presentation.
Hi, Alyssa. Before you do that, I just wanted to say one quick thank you to Anne and Michael and do just a quick introduction. So first of all, thank all of you guys for joining us today. We have a very large group of folks on the line today. So we're excited that this topic is something that you find valuable. We're incredibly grateful to Michael Kenahan and Ann Rachko of BDO for sharing their expertise. There are featured subject matter experts for today. I'm not going to go through their illustrious bios and all of their qualifications and accomplishments, but I know that you all received it as part of your registration packet. So I do want to also let everybody know that Matt Scudera, my colleague from the Credit Research Foundation, will be our question and answer moderator, and we encourage you to use that Q&A box, like Alyssa said, to ask as many questions as possible. Take advantage of having these two folks hostage for an hour today and pick their brains as much as you can. So with that, I'm going to turn it over to you guys, and thank you again for sharing your time and your expertise with us.
Of course. Thank you, Zine. So real quick, I'll do a real quick introduction, then turn it over to Annie for an introduction. But Mike Kenahan, I'm a managing director at BDO. I've been working in the unclaimed property space for close to 15 years. I've been with BDO for the better part of the last 7 years, and then have about 8 or so years on the audit side. So worked for one of the larger unclaimed property third-party audit firms that conducts the audits on behalf of various states. Looking at the attendee list, I'm sure some of you have experienced that, so apologize. Don't hang up. We're here to help today, and to Zine's point, we encourage the questions, encourage the dialogue. There's lots taking place in the unclaimed property world, and we only have kind of a limited amount of time today. So I do want to make sure that we are covering the topics that are most important to you. So again, we do encourage the questions. Before I get into the agenda though, Annie, you want to give a quick intro?
Sure. I'm Annie Rachko. I am a senior manager at BDO. I have about 10 years of unclaimed property experience, 6 of them at BDO. I share a very similar background to Mike. I also used to work for the largest third-party accounting firm, auditing firm. Worked there for about 4 years prior to joining BDO.
Perfect. So obviously today the presentation is going to be a focus on accounts receivable, because that's what's most important to the group. But if you go to the next slide on the agenda, we're going to spend about 7 or so minutes on each one of these topics as best we can, and then really get into the meat of this and the value, which I think would be on the Q&A section. You can ask questions as we go through this. If you want to write something in the chat function, and we can do our best to incorporate that in the topic that we're discussing. Or if it's preferred, you can wait to have questions until we're done with this. It's really open to what makes sense to the audience. But we thought the best format of this would be to do like an unclaimed property overview. I'm sure there are individuals on this presentation who have a lot more experience than others. So spending a few minutes just to kind of level set and explain what unclaimed property is typically helps. We're then going to transition into focus on, why does unclaimed property matter specifically for accounts receivable? And there's a lot on the topic of AR and a lot on the topic of unclaimed property related to AR that we can get into. After that, we think that, understanding what states are doing and what's happening in the market and kind of the change that we're seeing at the jurisdictional level in terms of outreach and solicitation is very important. I mean, states are very active in this space today, probably more so now than ever. And just giving you guys a heads up as to what it is that you should look for, and make sure that you understand what to do if you do actually receive a notification or an outreach letter from a state. Then we're going to spend just a few minutes kind of giving you guys some perspective around, mitigation options, what you can do in terms of preventing risk, what you can do to mitigate risk, talk a little bit about some of the more favorable amnesty programs and VDA programs that exist, and then just followed up with Q&A. So with that, because I know there's a lot to go over, I'll turn it over to Annie to go through the unclaimed property overview.
Thanks. So unclaimed property, kind of 101, when we're talking about unclaimed property from 10,000 feet, really what we're talking about is any intangible property that a company has that has not had any owner activity for a certain amount of time. So an aged credit of a net credit customers. The states say that the company has the responsibility to report that property after the amount of time has passed, and they say that the property is better off in their hands than in the hands of the company. And we all obviously know better. Really, states use this as a source of revenue. They use it to avoid raising taxes because they can use the funds for the public good. And unclaimed property laws are going to apply the exact same way to all different entity types: C Corp, S Corp, partnerships, LLCs. All different entity types are subject to unclaimed property laws. Dormancy period is that amount of time that I discussed when talking about the high level unclaimed property definition. This is the amount of time that is going to be given by a particular state. It's going to vary by state and property type, that needs to pass in order for property to be considered reportable. And for accounts receivable specifically, the dormancy period is going to range from 3 to 5 years. And one thing that I think is important to understand, since we're really trying to focus on accounts receivable, is there are some states, I would say approximately 10 states, that have a business-to-business exemption related to accounts receivable. Meaning, if you have a customer that you might owe an amount that could be considered unclaimed property, if a state has a B2B exemption, they would say that that property does not need to be reported if that customer is a business. Couple things that are important to understand about B2B exemptions is it's important to know specifically what the B2B exemption is for the particular state. You'll see Texas has what we call a deferral, meaning if Texas says there's a B2B exemption if the customer is a current customer and has been a current customer for the last year. Once that customer is no longer considered current, Texas would have the expectation that you escheat all property that would be owed to that customer, which then could open up interest and penalties. So it's important to understand the difference between a full exemption and a deferral. And also, although a lot of these exemptions exist, the state can really take them away at any time. Illinois used to have a very favorable B2B exemption for accounts receivable. And a few years ago, they removed it from their statute and they applied that retrospectively. So they expected companies to escheat all of the property that was considered exempt for previous years on the next report that was due. Talking about common types of unclaimed property, and we do these presentations a lot, and we have conversations with many companies about unclaimed property. And I think that what a lot of companies think is unclaimed property really is only property that exists or liability that exists on the balance sheet, meaning uncashed checks or an aged credit. And that is a component of unclaimed property, but I think what's most important to understand is not the unclaimed property that exists on the balance sheet, but it is the property that was once on the balance sheet and was subsequently written off. So if we're talking about really accounts receivable, it's not just going to be the aged credits of net credit customers, the overpayments, the unapplied cash. It's also going to be the credits that were once on the AR aging and were written off. And if you start to think about the different accounts that are usually used as write-off accounts, miscellaneous income, bad debt expense, maybe there's a de minimis account, and all of the different types of transactions that kind of go through these accounts, it can start to become easier to understand that accounts receivable for unclaimed property can be a pretty big issue, because in unclaimed property reviews, the auditors are casting a really wide net, and they would ask a company to show why a credit that was written off is not owed. There are two sourcing rules that if you get anything from this Unclaimed Property 101, these are the most important to understand. And they really dictate where this unclaimed property would be owed and what state the particular property is owed. The first rule says that if you have any properties, you have an age credit, the property would be owed to the state of the owner's last known address. So I live in Pennsylvania. If I didn't cash my payroll check, BDO would have to escheat that check to Pennsylvania after 2 years, which kind of makes sense. It's a little bit easier to conceptualize, like liability sitting on the balance sheet. But the second rule states that if the address for the property is unknown, so you do not have an address for the owner, that property would go to the state of incorporation. So again, same situation. I don't cash my payroll check. For some reason, BDO did not have my address. That check would be owed to Delaware after 5 years, since BDO is incorporated in Delaware. And that second priority rule is so important because I'm sure when you Google unclaimed property or you think about unclaimed property, you think about the material estimated liabilities that exist in audits and in other reviews. And because of that second priority rule is why states of incorporation are able to estimate a liability in the absence of records. So we thought it would be a good exercise to kind of walk through this estimated calculation.
Hey, Annie, sorry. One thing to add to with the first priority rule. So as you're sitting there trying to understand this, it's likely that many of you have a very large customer base. Could be thousands of customers, could be tens of thousands of customers. And when you start to really understand that, I'm sure that it's not as if all customers reside in one state or one jurisdiction. They're probably all across, the US and maybe some international. That could mean, and this happens a lot, that you could potentially have an unclaimed property liability in all 50 states. Or in 1 year, you can have an unclaimed property liability in 20 states. The next year, it could be 25, it could be 30. And it's really going to be dependent upon, where that credit would sit and where that owner name and address is. The unfortunate thing about unclaimed property, and Annie kind of highlighted this a little bit. Well, let me caveat that. One of the unfortunate things about unclaimed property is that states don't conform rules, right? So there are different filing deadlines, there are different expectations, there are different definitions of property, different dormancy periods. So understanding your compliance obligation, even at face value, for larger organizations with a significant customer base, can be troublesome because you're reporting to many, many jurisdictions based upon the interpretation of that first priority rule. So I just wanted to point that out because I do think that that's likely a very relevant and real situation for the majority of the people on the call. Sorry, Annie.
No worries. So this is an example of an estimated liability. And really, the state of incorporation is the only state that is able to estimate a liability in the absence of records. And the reason why this is extremely important is if you get an audit notice and your state of incorporation is participating on the audit, most of the time, these unclaimed property reviews are going to go back 10 to 15 years. And I would say 99% of the time, companies are not going to have records going back 15 years that would be able to be used, that you would be able to only pay the property that would be considered owed per that first priority rule. So as a result, states of incorporation estimate a liability for years where companies do not have records. So this is an example of an audit client, a client that we had that was under audit. We'll just walk through it high level. You'll see that this audit went back to 2002. And revenue is going to be used as a basis of estimation. And between 2002 and 2016, this company had $8.8 billion of revenue. And for accounts, this is an accounts receivable example. And in an audit, what the auditors are going to request is quarterly AR agings for as many years as available. And they're going to identify all of the credits of net credit customers on an AR aging, and they're going to send it back to the company. And they're going to say, provide documentation that shows how the credit was resolved. So it might have been refunded, it might have been applied to an invoice. If it was written off, they would need documentation that shows why the credit was written off and that it was written off for cause. And you would need to show documentation that shows really that these credits are not owed. So in this example, the company was able to provide records for 2012 through 2016. And they went through the remediation process after the population was identified of aged credits. And they were unable to prove that $1.4 million was not owed. And we say that unable to prove instead of saying $1.4 million was unclaimed property, because it doesn't mean that $1.4 million was owed. It just means that the company did not have the documentation to show that it was not owed. And that's important because really unclaimed property reviews are an accounting exercise and a record retention exercise. A lot of times companies aren't paying exactly what they owe. They're paying more than what they owe due to lack of documentation. So $1.4 million was identified as owed. And out of that 1.4 million, only 42,000 was sourced to Delaware per that first priority rule. So you may think, okay, if we're looking for a Delaware historical liability, we'll use the 42,000 as a basis of estimation. But since the estimated liability is going to all be considered unknown, states will use the total unremediated amount as a basis for estimation. So they'll use the 1.4, they will divide it by the years of revenue where records were provided, so 12 through 16, to get this very small error rate of 0.04%. That error rate is then multiplied by the revenue for the years where records did not exist, so 2002 through 2011, to get this estimated calculation of 2.18 million. You then will add the actual amount per the first priority rule, as Mike kind of mentioned. Depending on your customer base, you may have a decent unclaimed property first priority liability owed. You would add that to get 2.22 million. Delaware has a 50% interest statute to get 3.3 million. And really, we're not walking through this to scare anybody. These calculations are very real, though, and it is important to understand that if you're involved in an unclaimed property audit or an unclaimed property review, and your state of incorporation is involved, that the state of incorporation can estimate a liability in the absence of records. And why that is so important is if an estimated liability is possible, you need to understand every piece of documentation, how that will impact the estimated liability that's requested and provided. Meaning, in this situation, if a company had records from 12 through 16, but maybe they had a systems change in 2013 and they were unable to research the 2012 credits, that unclaimed property liability or that unresolved liability could be $1 million, and that would inflate your total estimated liability significantly. So it's important to understand that this liability exists and it is very real and it can be material, and always keep that in the back of your head, especially if you're in an unclaimed property review.
And we have our first question that came in, and if I could ask that of you guys. And the question is this: is this something that you usually see the AR team managing, or does it fall more to accounting or FP&A? Very good question.
That is a very good question. We get that question all the time, especially companies who are under audit, who should be taking control of the audit and the record requests and everything. And really the answer is usually in an unclaimed property review, there's one primary contact. Sometimes that could be a controller, VP of finance. That's going to vary by company. But the truth is that really all process owners for property types are going to be involved at some point in an unclaimed property review. So if you think about the example that I just went through of how auditors identify a population for accounts receivable, age credits of net credit customers, really the companies usually will likely rely on credit managers and other accounts receivable process owners to research and review those credits, because somebody in Treasury isn't going to be able to have that information. So it's usually not only one group that takes ownership. At the end of an unclaimed property review, most groups are involved at some point in time throughout the review.
Great. And we have another question that came through the chat box, and that's when writing off a credit against a debit with a net in favor of the customer, would that be a liability? And
hey, Andy, maybe the next slide I think covers some of this too, so it could be helpful. Great question, and it's a perfect transition into some of the top concerns within receivables. And Andy mentioned a little bit about how populations are defined. For the most part, I would say states have consistency in acceptable ways in which you can define a population. In both situations, though, to answer the question, to the extent you can demonstrate that there's a debit offset for a credit, it's a legitimate offset. So ultimately, at the end of your analysis, you want to be in a position where you're kind of putting forward, as best you can argue, only the population of customers for the period of time you have records that sit in an overall net credit position, right? So hopefully that answers the question. I mean, you do get an offset on the debit side of things, and there's various ways that you can do that depending upon the facts for each company. Talking to this slide a little bit, some of the top concerns that you see with receivables from our standpoint, the biggest is it's complicated, right? It's not as easy to conceptualize as a check being issued out of a bank account, right? Or a payroll check being issued. And then you just have to figure out what happened to that check, whether it was void or reissued, cashed, whatever. There's somewhat of a limited number of, possibilities that can take place on the disbursement side. When you're talking about AR, there's so much that can happen that can cause potential concern, right? And one of the first things that you would do is you have to sit there and kind of think about, what industry you're in, because every industry has its whole, unique host of issues related to, receivables. So like pharmaceuticals could have, they would, very different AR related concerns than say healthcare, right? As would, distribution. So you need to understand everything that's going into AR, because any sort of representation as a credit balance on your books and records, again, to Annie's point earlier, is going to be considered unclaimed property unless you can prove otherwise. So if you have, legitimate prepayments, if you have legitimate, contractual adjustments, if you have, pricing adjustments, if you have discounts, allowances, whatever it is, all of that needs to be understood and considered so that you can either incorporate those characteristics into your analysis or hopefully get to a point where you can exclude them, because in some cases you could justifiably argue that those instances have no likelihood of ever being unclaimed property, right? AR in our world also typically for a number of these reasons lends itself to being the property type. And we say property type like accounts receivable, payroll, accounts payable, gift cards. These are property types that states test and assess a liability on. AR for organizations that have customers is generally the property type that unfortunately creates the largest liability. And I think that there's a few reasons behind that. Some of it could be just the sheer volume, sheer number of customers, number of transactions that you need to research and prove, and there's a cost benefit analysis to doing so. I think the complexity of what goes into receivables complicates the issue, which in turn increases liability. The other thing too is that, oftentimes, documentation to support why a credit was reclassified for whatever reason typically doesn't exist at the same capacity that it would for why a check was voided. So some of this, and if you take away some good action steps from this presentation today, like think about that and think about overcoming that burden of proof from your own standpoint, right? And if somebody were to say to you, could you go back and show me, the resolution of, Mike Kenahan's credit on his account that sat there for 92 days in 2016, could you show me tangible support that credit was applied appropriately, right? And if you can't, unfortunately, the states are going to say, well, guess what? That's unclaimed property. So policies and procedures, keeping the appropriate records, having all of that information, I think is also paramount in mitigating your unclaimed property risk related to receivables. One other point too, for whatever reason, when you think about what companies do in terms of filings, right? So every year states ask that, organizations turn over their unclaimed property through the annual compliance report, most in the fall or spring. AR gets missed, right? People don't really realize that there's an AR liability. And a lot of times you don't see AR being reported at the same frequency or materiality as you would some other property types that truthfully don't carry that same level of risk. So hopefully that makes sense. I did see.
Well, one thing to add too, I did a presentation based on AR last week, and a lot of the questions were based around de minimis credits. And I think it's important to understand that any states will say that a penny is owed. So any de minimis credits that are written off would be considered owed. And a lot of companies have a de minimis write-off policy, which absolutely makes sense. But understand that that would be viewed as unclaimed property. And although maybe it's credits under $50, that could add up. So that's something that's important to understand as well.
Great. Ann and Michael, we have a number of questions that came in, some real good ones. Let me start with the first one I have here. Can you elaborate on defining dormancy of an account?
Yeah, of course. So every state has what they define as that dormancy period for a property type. And that's one of the slides that Annie had shared before. Most are between, and nowadays, 3 to 5 years. So that just means that in order for the state legally to take claim to a property, that transaction needs to age, at a minimum, the timeline outlined per dormancy by that state, right? So that's what dormancy means. Now, dormancy doesn't mean it's unclaimed property either, right? Like you could have, balances on your accounts that go beyond 3 or 5 years, and you can pay them back to the customer. Or in some instances, in some industries, those are legitimate active receivable balances that are prepayments, and each year that stuff's being drawn down based upon the current activity, and then in which case we would argue that's not a dormant balance, right? So there's a bunch that you need to understand with that term and that term dormancy. But at face value, right, if you were just to say a customer went bankrupt, you don't know who they are anymore, it's legitimate unclaimed property, you would need to wait at a minimum 3 or 5 years, depending upon what the state says, before you turn it over.
And the transaction date or the document date would be used to determine that 3 to 5 years.
Yeah. If I could ask another question, it's in the same line as the last one. It's if a credit has an expiration date, such as 180 days, similar to a coupon, and not claimed, is that considered escheatable?
Oh, that's a great question. Unfortunately, yeah. I mean, the states go after that stuff. You see a lot of the T's and C's being brought into question around other property types like gift cards, but you cannot circumvent unclaimed property law through contract, right? So you can't establish, internal, deadlines for redemption, or, a credit is no longer valid after X amount of days, with the sole intent or sole purpose of circumventing unclaimed property law. And even if that's not the sole intent or sole purpose of what it is that you're trying to do, I have yet to see that really be a strong argument where it was enough to say that it's not abandoned property. In fact, we've seen it be the opposite, where companies have had policies like that in the past, and it's kind of gotten them into a little bit more trouble because there is legitimate balances that haven't been repaid, haven't been applied to future balances, or ultimately haven't been escheated, that are now brought into question.
Great. And one more question. If an AR credit from a well past the reporting period is reported, a state does it, and I'm trying to read through the question, is reported, a state does, it then increase a company's risk of audit. So if they have a credit that's well past the reporting period, does it increase your risk of a state coming in for an audit?
Yeah, and Annie, maybe you go to the next slide, because I think that this kind of covers some of that, but I'll give you my 2 cents on it, and then Annie can go through it with the state outreach and updates, because again, it's kind of a perfect transition. So thank you for that. But we get on these presentations, right? And we do a decent amount of speaking, or at least we did kind of before COVID started. But and we would stand in front of, hundreds of people and say, look, if you haven't filed, don't file. And people would be like, what are you talking about? Like, you're telling me not to file unclaimed property. And the reason is that states are becoming way more sophisticated in their outreach, way more sophisticated in how they identify organizations for non-compliance, that if you were to pay, past due property to a certain state that's more aggressive, it could trigger things. If you were to pay material past due liability to any state, it could definitely trigger things. So what we caution on and what we advise is you really need to understand the universe before you become compliant. You need to understand where your risk is by state and whether or not that risk is material to a company before you establish a well-defined, compliance reporting platform. Sorry, Annie.
No worries. So the recent trends in state outreach, a question that we've gotten over the course of the last couple of years is if we think that states are going to start to increase their unclaimed property activity due to the deficits in budget due to COVID. And the answer is yes. States were still active during COVID. And what we're starting to see now is many states are starting to implement self-audits or audits in general to try to get cash in the door. And really what is important to understand when you think about state notices and outreach related to unclaimed property is exactly like dormancy periods, reporting, and statutes, it's going to vary by state. And the type of outreach that you get will really dictate your response. So not every outreach is going to be an audit. Not every outreach is going to give you the opportunity to do a VDA. So it's really important to really understand exactly what these outreaches are and what they're asking a company to do. Delaware, they send out what we call VDA letters. This started back in 2016. Prior to 2016, if you were identified as a company for audit, you were audited. Now what they do is they'll send out a warning letter to companies, say, hey, you're on our radar. You have 90 days to enter into the voluntary disclosure agreement program. If not, you will be audited. They send these letters out quarterly, and usually about 30 to 90 days later, audit notices will follow for companies that have ignored the letters. Illinois and other states have started to implement a self-audit program, and they utilize third-party auditing firms to kind of help with the outreach. But really what they're doing is they're giving companies 6 months to identify all unclaimed property owed to the particular state. And really what the third-party auditing firm is doing is they're going to review the final submission and make sure it makes sense. But really the objective is to get quick cash in the door. And Wisconsin has started a one-time VDA program. So some companies have been getting reminders or FYI notices that say, hey, we have a VDA program if you would like to join. There has been some changes in behavior over, I would say, the last 3 to 4 years. As I said before, all states do not send the same notice. Delaware has their VDA letters, Delaware has their audit letters, their self-audit, and there's also some states that send out questionnaires. New York, PA, North Carolina, all send out questionnaires, and they all mean different things. New York, usually, once you answer the questionnaire, it results in them telling you need to enter into one of their voluntary programs. North Carolina views it as an audit. PA will review it as a self-audit. So again, if you get any of these notices, they all can be treated differently and usually are treated differently. Some need to be treated as the whole company. Others you can just answer or go forward as the one entity that got the letter. But I think the most important thing to understand is that these letters or these notices should not be ignored, and you really should understand exactly what your risk is in the state before you start to send anything or respond, but definitely do not ignore the state outreach. And I see that it's just going to increase, and you're going to see more self audits, more questionnaires, more audits, because states really need the revenue. One other thing quickly is California recently added a question to their tax return. So all tax returns, C Corp, S Corp, partnership, LLC returns, asking companies to disclose whether they have filed unclaimed property, and if so, how much property they filed. We don't know exactly what they're going to do with this information, but my guess is they're going to compare the companies to other companies, use different software to make sure companies are filing appropriately. And if they're not, audits will likely follow. We have also heard that they're probably going to start a VDA program, which would be great for companies with a high exposure in California. So I think that we're going to see a lot more activity from California. And if you do have to answer these questions, what we would recommend is understanding what your risk is in California, maybe holding off until that VDA program exists if you do have a material risk.
Excellent. So here saw some questions. Here's Matt.
Yeah, we do. Apologize. Did not want to interrupt.
No.
The first question we had was, can we get an email with a copy of the presentation titles? And for everybody listening in, we will send everybody at the end of this a copy of the presentation and the contact details for both Ann and Michael on there as well. So you will get a copy of that. Then we have several others that came in. And the first being, and let me just jump to that. If you have issued price credits to offset short payments, even though customer was billed same price as you quoted, can you offset unrelated credits to offset the cost? So if I read through that, can unrelated credits to a particular item be used as an offset?
As long as the credit is related to the same customer, the transaction is related to the same customer, you can absolutely net transactions together. So if it's a legitimate credit and a legitimate debit, you can offset them. And really the first step in any unclaimed property review to identify a potential accounts receivable liability starts with understanding what the net balance is of each customer. So any net debit customers would not be included in a review. So as long as you're netting transactions from the same customer, that is appropriate. You cannot net transactions of different customers together.
The only thing I would say with that too, and I'm probably getting more detail than I need to be, but would be for like a discount for paying on the terms provided. You wouldn't be able to kind of back out that discount, which was allowable for your contract, and use that discount difference as an offset in the future. But a legitimate short pay where, you know, it's proved and it's defined and it created a debit balance on the account can be used to offset credits in the future.
Great. Why don't we go through one or two more and then allow you guys to continue through your presentation. The next one is, if you have inventory losses associated to a customer, can you offset credits against that loss, even though the inventory was not shipped/billed?
It's an interesting question. And I think it's touching a little bit on, you know, the property type that we would classify as GRIR. And really in the GRIR world, where you have, you know, tons of ins and outs, right? Whether it's vendors or customers where you're sourcing product, there are so many balances, right? And sometimes the balances come in the form of payments. Sometimes the balances come in the form of damaged product, damaged inventory, or overages in inventory, or underages in inventory, whatever it is. That's just the daily cost of business. And all of that stuff typically gets aggregated into this one conglomerate of a mess of GRIR. Years ago, states, in particular Delaware, tried to pursue that property type as a legitimate means of unclaimed property liability. McKesson, what was the organization that was involved in that? They went to court and basically kind of settled, and statutorily in the state of Delaware, you know, classified GRIR out as a property type of liability. So it's really an exempt property type. So states, well, states like Delaware will not proceed with trying to assess a liability related to anything GRIR related. It sounds like that's GRIR related. So if it is, you're probably okay. Not all states are the same, and you can't ever predict what an auditor is going to do. Our advice around anything, kind of GRIR related would be to make sure that you have an understanding of risk and make sure that your policies and procedures are defined enough so that you can kind of validate that money in some ways is not owed to the vendor, or in some cases owed to the customer.
Great. Now let's go one more and then allow you guys to continue on with your presentation. This individual got disconnected, so they apologized. But the question is, what is the risk in writing off credit balances instead of treating them as unclaimed property? So fairly broad and similar to what you opened with, but just what are the liabilities for an organization?
Yeah, Annie, you want to?
Sure. So really the risk of writing off as opposed to reporting an unclaimed property, really in an unclaimed property review, any credit that is written off and would be associated with a net credit customer would be considered owed as unclaimed property if you don't have documentation to show that it's not owed. So when we're talking about that estimated calculation, or even you're talking about amounts that would be due to a specific state per that first priority rule, really any credits that were written off and were not written off for cause would be either included in that numerator for estimation, or they would be considered owed. So really the risk would be that that property would be considered owed. And then also, if you're in a situation where a write-off account is being reviewed and you really think about how these populations are identified, you could end up putting yourself at risk for including transactions that maybe aren't exactly related to accounts receivable, but an auditor is unable to distinguish, and you could be opening yourself up to a higher liability, even separate from the amounts that were written off if they were considered owed.
Yeah, and then another great segue into the next topic here, but there's a lot of organizational risk as well. You don't want to get into a situation where a state has a reason to come in and do an audit, right? Audits, I don't think we mentioned this, which is shocking, but audits last, on average 3 to 7 years. They're extremely intrusive. Any state can mandate an audit, and then what ends up happening is they outsource that audit to a firm like one that I used to work at and Annie used to work at, and that firm has, contracts or relationships with pretty much every state. So in today's world, you see a state like Delaware mandate an examination or mandate an audit, and then, after several months, there's 15 to 20 other states on that audit, right? So you do want to kind of understand that risk, in addition to, just the concept of in today's climate, interest and penalties for the first time in a long time are on the table and are very real. Delaware charging 50% interest. California notoriously has charged material interest compounded based upon the age of the transaction. So there's some real liability associated with not treating these property types kind of appropriately at real time. Liability, both in terms of resources and potential cash that would need to get paid to satisfy the obligation. So I want to spend a few minutes and then we can get into a more detailed discussion on some Q&A. But mitigation, if you're in a situation, and I'm sure a lot of you are, where you're trying to understand what unclaimed property is, I think this type of presentation is extremely helpful, because it helps give some perspective around, why AR or why unclaimed property is real, and really gives you visibility to knowing what to do if you get a state outreach letter. Like Annie said, you need to understand what that means and don't ignore it. But if you're in a situation where you can manage risk, like you're not under audit yet, one great outcome for a lot of companies, and you need to understand the pros and cons to doing this, would be to enroll and do like a state defined, voluntary disclosure agreement or amnesty agreement. Delaware, for all the things that Delaware does, they do have a very favorable, VDA program, which is going to give you an abatement of interest and penalties. It's going to have more favorable concessions in terms of your arguments. You define populations differently in a VDA. So in more cases than not, self-reporting is going to substantially lower your potential liability. You don't just want to enroll in a VDA without knowing what it takes to comply with the VDA, right? In order to get those benefits, it is a process. None of what it is that we talk about is fun. An audit's the least fun. A VDA is probably the second least fun, if that makes any sense. So you do want to make sure that the cost benefit analysis is done and that it is something the organization is going into eyes wide open. Then it's just really, policies and procedures, making sure that you understand, the components that need to be retained, what it is that process owners like yourselves or others in the receivables group should be doing to paper up and to document, why credits were, potentially reclassified or not paid back. I think having a good process in place to, try to reunite those credits in real time, whether it's every 6 months or every 12 months, kind of varies by organization and volume, pay them back, just a regular review of receivables to make sure that nothing gets missed and that you're not inadvertently putting yourself at risk. The other thing that real quick is there's a lot you can do, on the front end of this to kind of help identify liability. And I'd say a decent amount of the project work that we do is broken out into phases where it's like a phase one, you understand the organization and then figure out, where their risk is by state and then come up with a more defined, outcome for mitigation. So this, we don't need to talk about. Go to the timeline, Annie. This is helpful, and we'll send this in the presentation where you can see it's just kind of the deadlines for fall compliance. Unfortunately, when you think about unclaimed property and your annual compliance, it's either fall or spring for the most part. But given the due diligence requirements and what needs to go into preparing a report, it is something that needs to be considered really annually and monthly. And it's not something that you could really wait until October to start if it's an October deadline filing. So this is helpful in kind of giving you guys perspective as a takeaway if you did want to implement some type of fall compliance or any compliance timeline for your organization. Same thing with spring. So that's, I think that leaves about 10 minutes, probably not as much time as we had hoped, but I know we got through some questions. I see some others are coming through, but I don't know if there's any other questions, feel free to ask them in the Q&A or chat function and we'll do our best to get through them. If not, rest assured we will respond back, to the group with the response to that question after the fact, so nobody's left hanging.
Great. Michael and Ann, thank you. There are a couple of other questions that came in. The first one being, if a customer is active but has an old credit, would the credit be considered unclaimed property?
That's a really good question, and we get that a lot. And really, one thing that we say generally is if you have anything that is owed to a current customer, you really shouldn't be escheating it at all because you have a current relationship. If anything, you would refund that to the customer. If you're in a situation where you have a current customer, they're in a net debit balance, you just have a credit that has been sitting on the aging for the last 7 years, we would encourage you to encourage the customer to apply that credit. It's not a good practice to keep aged credits regardless of balance, regardless of how active the customer is or if it's a current customer on the aging, because states, and as Mike said, you never know what they're going to do. They may have a different opinion and they might view that credit as owed, even though you have other transactions and it's a current customer. We would say kind of put it in your best practices and policies to try to resolve those credits in the normal course of business. One thing that we have found that really helps is sending the customer statements that shows that those credits exist so that they can be encouraged to take them. But it wouldn't necessarily be owed as unclaimed property, but it would be recommended to resolve that credit internally.
Yeah, and one quick add on to that, and we tell this to companies and to clients all the time too, but like if you haven't done something routinely in the past, right, don't don't do something differently today because of this, right? So like, if you know that there is $1 million of credits that exist, don't all of a sudden write them off, or really don't all of a sudden even try to pay them all back. Those sorts of mass cleanups, even when you think you're doing the right thing, could be very troublesome in terms of how a state can define your historic liability. Because if you go through the process and say you have records for 7 years, and all of a sudden in May of 2022 you pay everything back, well, that demonstrates that in your mind you say, well, look, I have no unclaimed property, I've paid it all back. But states of incorporation, states like Delaware, states like New York, would view that as what's called like a funds returned or a change in process, and they would say, okay, well, for the last 7 years, you paid all that back and you paid $1 million, but you should have done it for the last, 15. So for the prior 8, we're just going to use what you did currently as admitted liability and estimate backwards. And a lot of times companies do that just to get it off their books, not really understanding the implication of their action.
Right. And this is a similar question. What about a scenario in which a customer overpays an invoice by a minimal amount, in this case, $8.15? Is it okay to write the amount off?
So that would kind of fall into the de minimis category. And when we're talking about unclaimed property and related to accounts receivable with clients, we recognize that unclaimed property is not always the main objective. And you have to kind of do a cost benefit analysis. You're not going to research a credit that's under $10 to determine if you should pay it back to the customer. It just doesn't make sense. But from a state's perspective or an unclaimed property perspective, that credit would be considered owed. So if a company has a de minimis write-off, which in some situations makes sense, we would recommend that if you have a compliance process, to incorporate that de minimis account into the compliance process, because states would view it as owed. And as Mike kind of mentioned, wouldn't be our recommendation just to start filing all the de minimis credits that you have sitting in a de minimis account. But as you start to have best practices, or if you mitigate risk, the de minimis account really should be incorporated in the annual escheatment, because states would view that as owed.
Great. And why don't we go with one more question? And I think you have a slide that will help answer this as an example. The question is this: how far back are we required to go? Does it vary by state? Example, California. And I don't remember the slide number, but I think you had one that was a good example.
Yeah, so most states, and this is kind of a tricky, it's more difficult to answer, but most states will require you to go back, 10 years plus dormancy, right? So that means when you think about the average dormancy period, like we mentioned before, it's typically 3 to 5 years. So most unclaimed property reviews are going to be, that 13 or 15-year period of time. Now, where this is complicated is if you don't have records, obviously you can only report what it is that you have records for on a state-by-state basis. But for that period of time where you don't have records, that's where you really need to understand your estimation risk, because estimation will be done for the remainder of the period of time where you don't have records in accordance with that state look-back period. So it's not that simple of an answer, but high level, 13 to 15 years.
Great. We do have a couple other pieces that came in the chat, questions that were in the chat box, and we have a minute or so. If I could just ask one or two of those, it's what dates are penalties and interest based off of?
So with everything with unclaimed property, that's going to typically vary by state, but generally it's going to start from the date that the property should have been reported initially. So if the property should have been reported on October 31st of 2020 and you don't report it until October 31st of 2022, you would have 2 years of interest. And how that interest is calculated, or the percentage of interest, is going to vary by state.
And one final one, similar to what I think we just went through, is do you have further details on the individual state requirements? Where's a good location that somebody could find out what the individual state requirements are?
So we do have details on the individual state requirements. They're constantly changing. You can go to a state's website. There's definitely matrix available online based around dormancy period, by property type, the reporting date, due diligence requirements, interest and penalties. So we do have we do have information that we could provide, but one thing to note is that it's constantly changing. So it's important to constantly be looking at the state's websites and changes in laws, because that could change on an annual basis.
Great. Also probably a great opportunity to engage with professionals like yourself. that can help you
Exactly.
Shoot us an email. Yeah.
former owner of a process for a large corporation across all aspects. I know it's a big task, and great to have some advice. We are closing in on the end of today's webinar. I'm going to toss it back to Alyssa for some final closing comments, but Ann and Michael, I want to thank you both. This was just an absolutely wonderful webinar and share of knowledge with us. You guys did a great job. I also want to thank all of today's participants, and we had a very large group on. I want to thank you for joining us on this important topic. If you have any further questions, please reach out to Ann, reach out to Michael, or reach out to the team at CRF or FCFP. We'd be more than happy to forward your questions over to today's presenters. And other than that, I hope everybody has a great day. And with that, Alyssa, any final closing comments for us?
Yep, as a reminder, we'll be sending the presentation slides after the webinar is over. So keep an eye on your email for that. And we'd greatly appreciate you filling out our survey that will pop up after the webinar ends. We'd like to once again thank Ann and Michael for taking the time to present to our group, and thank you all again for joining us. We'll see you at our next webinar.
Thanks, guys.
Thanks so much for your time.
Thank you, everybody.